Asking, can I afford this loan, is the wrong question. The right question instead, what won't I regret signing? Today, I want to talk about 2 things you need to measure and 4 stress tests you need to do before taking on new debt. Too often working with business owners, I've spoken to them and I've heard, well, we just went and got a loan without thinking about the consequences. And us as consultants had to work with them to dig out of the hole they created from not thinking the decision through. And often that comes because they don't even know how to approach it. They don't know the right questions to ask. So they go to their banker and they assume that the bank is looking out for them. But the bank is not looking out for them. The bank isn't trying to hurt them. The bank wants and needs them to be successful, but the bank is looking out for itself. It's looking to make sure that the debt is compliant with what they need. That is completely different than what many business owners are looking for. They could be looking for stability, safety. They could be looking for helping them sleep at night. Whatever it is, those 2 things may not always align, and you can end up in a situation where you have bad debt. If you find yourself thinking, well, this payment looks manageable, I can handle it, that is not the right thing to be thinking or saying. The bank is asking, can they pay us back? And they're doing very specific things to look and understand that. Debt isn't just a math problem, it's a commitment problem. If a monthly decision you're making for the next 3, 5, 10 plus years, and debt becomes dangerous because debt payments are fixed even when cash flows aren't. So the real question is, can we pay this in the next 24 to 36 months? And how much risk does this put on the business? The first number we need to understand our true cash flows. By understanding our true cash flows, we can understand what money we actually have to pay the debt. I've written about this in the past. I call this the steady state cash flow. I'll link you to an article with that concept. What the bank is looking for is their DSCR. This is the debt service coverage ratio. You can look up how this is calculated. This is your debt payments by cash, trying to figure out how much cash do you have over the payment of debt and what can you afford. They want to make sure that you're in a healthy spot, that cash coming in and out of the business can cover the payment of that debt. That's the bare minimum to determine if you can afford the debt. But often you'll get a healthy DSCR, but that doesn't mean that it's healthy and good debt for the business. The only way that we can truly understand this is to run these 4 stress tests on the business. The first stress test is we want to compare your debt payments to your gross profits. Revenue is that vanity number that comes in. Gross profits are what you keep after the expenses directly related to the revenue. This is in some way the hidden revenue number. It's the number that you actually have to play with in this moment, right? You can change your model and you can increase your gross profits and gross profit margins. But the reality is today, gross profits are what they are. If that gross profit number is high in relation to those monthly debt payments, then you're in a great spot. We want to see ideally something over 25%, meaning you should never have debt going over 25% of that gross profit margin. You got to remember, out of that gross profit margin comes overhead and all the other expenses. So we got to make sure we have room to pay that, plus we have room for the profit. Every business is going to look different. Some businesses are going to have a lot more debt because they have a lot more equipment. They have a lot more fixed assets. Others, 25% would be an insane number, and they should be, say, less than 5% or 10%. We want to make sure that debt is not strangling the business and making you make decisions around overhead that are unpleasant and ultimately will sabotage the business. Stress test number 2 is we want to look at our DSCR and we want to say, in the most likely bad scenarios, do we still meet this covenant that they're asking us about right now? If our revenue drops 10 or 20%, if our margins compress or collapse, if our collections slow, if one unexpected expense hits, whatever is most likely for your business, we want to look at your cash flows in that period of time, and we want to measure your DSCR and see, do you still meet that covenant restriction? Sometimes they won't require interim reporting, so it doesn't really matter if you can get the loan or not. but it's good for understanding the health. We want to make sure that those cash flows are good enough to cover that debt payment, even when things go wrong. Because reality is, in business, things will always go wrong. Next, we want to look at timing. And timing in some way is similar to those bad scenarios, but I want to call this out specifically for those seasonal businesses. If you struggle with seasonality, uneven collections, timing is super important. So we want to look through the last 24, maybe even 36 months. We want to understand, what are the low months? What are the bad times for that business? And then when we have those bad times, assume it's going to drop another 20%. And in that scenario, can you cover your debt payments? And if you can't, are you generating enough cash in the good times to cover what you can't in the bad? If you can't figure that scenario out, you should be highly hesitant about taking on that new debt. And then last, I want to call this use of proceeds. What is the money actually used for? This is really important because debt should fund a plan. Debt should not postpone a decision. I'm going to repeat that. Debt should fund a plan, should fund growth, not postpone a decision. So if you're worried about laying off, if you're worried about being able to afford the next thing in business, we shouldn't be considering taking on debt to delay having to make that decision. We should have a real plan going forward. So good debt is an asset that produces cash. It's working capital with a clear payback. It's refinancing to lower your debt payments and buy yourself some time. Refinancing actually can, depending on when you do it in the cycle, if you do it early enough in the cycle, you'll actually save money, and you can do that analysis. That's easy analysis anyone can do. If we're doing those things, that can be good debt and smart debt to take on, no matter else what's going on. Bad debt is trying to cover for an issue you have without solving for that issue. It's, we need this because we've not collected. It's funding the external life cycle. It's, oh, we'll figure it out once we have the money. All of those are going to put you in a world of hurt and delay the inevitable decisions you have to make. And that is not a spot that we want to be. If we don't pass these tests, we can look for different loan terms. We can talk to different banks, figure out, is there something that would work better for our situation? We can look at making changes inside the business, tightening AR, trying to collect cash quickly, and improving the billing process to make sure that we don't miss billing. And again, we collect more quickly, working on pricing, labor efficiency, cutting overhead. There's all these business changes that we can make to make that loan more affordable if it's not today. And then we can also look at the timing. It's never pleasant to feel like you need something now and waiting 60, 90, 180 days, but sometimes that is what's needed for the stability of the business. Be willing to pause and come back when the time might be better. Our goal isn't to get debt. The goal is to keep the business stable, protect your cash, and sleep better at night as a business owner. So before we sign anything, start looking at that steady state cash flow, run your DSCR, and run these 4 stress tests and understand where you stand in each of the scenarios. If the numbers don't hold up under stress, don't sign. Pause, wait, reflect. Make sure you're getting good counsel. And that is, again, what we like to do and how we're here to help. If you want to work with us, if you need help with these sort of things, reach out to us at BisonCFO. We'd love to talk. Also, we help you if you're struggling with your financials, understanding your financial system within your business. We have this cohort, 5 Days to Financial Clarity. It's coming up here in April. We'd love to have you join us. Until next time, let's make more money.